We are seeing Wall Street try to continue to rebound after losses from earlier this week. Joining me today is Jason Weisberg from Seaport Securities. So Jason, we have seen a lot of optimistic data from earlier today with the jobless claims, pending home sales. How is the market so far digesting this right now?
Well, I mean, obviously the market's reacting quite positively to it. However, I take these economic data points with a grain of salt. I mean, we get so many of them now as compared to a few years ago. They really kind of are watered down at this point, and they can be modified as well, as we all know. We had a huge overreaction to the Fed meeting last week, complete overreaction. I mean, they've been telegraphing that what they're going to be doing for over a year. So for that precipitous sell-off was probably really overdone. Couple that with these, I guess, net, some more positive data points and not on the economy, and the hangover effect wearing away from the Fed meeting, we see the market actually carrying on the course that it probably should be on, based on earnings, based on the corporate health of America right now. And that seems to be very positive, and I think that is the underlying reason why the markets are where they are today.
Was it surprising to see the amount of losses, given the fact that it seemed that Bernanke didn't quite say anything that was too different from previous statements?
If you read a book and then you read it again, the words don't change.
Right.
And that's what was really confusing about last week. I think you throw in and you couple that with some of the Chinese data points that came out that spooked a lot of people. And I think once, cooler heads prevailed and you didn't have this, this knee-jerk reaction that we get that it's so headline-driven a lot of the times, I think that people realize, hey, you know what? This has been coming a long time. Things are on the mend. They can't get really worse, right, economically. And people, have a positive bias, and that's why we see the markets where they are today.
And looking at the housing data from this week, we did have pending home sales today beat expectations tremendously, but earlier this week we saw home prices and new home sales. What is the biggest gouge? What is more important to look at when we do see all of this housing data?
Well, I think it's important to see that people are actually out there trying to buy homes as opposed to renting them. They feel secure with their finances. Not being an economist, but my takeaway from that is that people want to put money to work before interest rates go up, and maybe they're buying. I don't want to say rushing to buy houses, but maybe they're accelerating their plans to buy a home in anticipation of rising rates.
And finally, the Fed does use the core PCE index to kind of gauge where inflation is. And about a month ago, it fell to its lowest level ever, and now it's slightly edged up. How concerning is that when QE was supposed to create kind of hyperinflation, but we're not exactly seeing that? We're seeing more disinflation.
I think that the Fed has done a very good job at tempering or controlling inflation rates, but they can't control everything as much as we'd like to think they could. And I think that the net result is however the Fed reacts, it's not an exact science. And I think that if we don't have this great inflation that they feared, a small move like you had mentioned to the up isn't a sign of panic, and neither is a small, deflationary move, a reason for panic. And I think that small moves are to be taken in stride. If we had a large gap, some dislocation in inflation rates, that might be cause for concern, but I don't think at this point it's really necessary.